Duffy, and I'm the Legacy Program Director. Thank you so much for joining us today. We are so honored that you have decided to be with us. I also commend you for taking this class to help build your knowledge in taxes. We all know that taxes can be a very challenging subject. So we have a wonderful speaker set up for you today that will help give you some answers to a lot of the questions that you have. Her name is Shamika Smalley, and she is the owner of Khalees Enterprises. It's a very dynamic speaker, so you will definitely be in for a treat today. Before I introduce her, I just want to let you know that if you do have any questions, go ahead and type your questions in the chat. And as the speaker takes breaks, I will go ahead and ask your question for you. Also, make sure that you are on mute. We want to definitely hear everything that Shamika has to say and avoid any distractions. So right now, I'm just going to introduce her. In 2003, Shamika received the vision to start her own business, helping those who needed assistance with tax preparation and financial literacy. She began doing taxes in Augusta, Georgia, before moving to the Charleston, South Carolina area. Shamika has a bachelor's in accounting and a master's degree in business. She is highly qualified and registered with the Internal Revenue Service as a practitioner. Shamika is also a high school business teacher, and she has been in education for 17 years now, teaching business courses. Her company is based on the belief that God has given us all the tools to live life and to live it more abundantly. We welcome you today, Shamika. Thank you.
Thank you, Teresa, for that introduction. And good morning, everybody. I am excited. I've been doing taxes for, this is actually 20 years for me. I am in awe that it's been so long that I've been doing taxes. And I've noticed that over the years, it's still a lot of individuals that just don't know or don't understand the complexities of taxes because there's so much. The tax laws change every single year. There's different updates. It's hard to keep up with it as a tax preparer. So I can understand from the other side of the client, even if you're doing your own taxes, what it must feel like to kind of not understand everything there is to know about taxes, or at least learn about what it is you need to understand to be able to help you out in your particular situation. So that's what I'm going to be here today to talk to you about is the ABCs of taxes. We're going to break down those complexities so that I can better help you understand how to go from the beginning to the end. And then that's what we're going to be talking about today. So I'm excited. Again, as Teresa said, if you have questions, I'm going to take a break after about halfway through the presentation. We'll take a break and take some questions. If your questions relate to what I've gone over so far, you can ask those questions. I will ask though that if it's not related to something that I just talked about, if you would just hold those questions to the end, because I may touch on that in the second half of our presentation. So your question may get answered in the second half if it doesn't relate to some of the things I just talked about in the first half. All right. So again, good morning and welcome to everyone. Just a second. Make sure I click the invite for everybody that was waiting. So when it comes to taxes, these are pretty much a whole lot of stuff that throws people off. And one of the things that I did was I called a couple of my family members and kind of bugged them for a couple minutes. Hey, tell me what it is that just bogs you the most about taxes, something that you just absolutely don't understand. Just whatever comes to mind, tell me what you don't understand. And these are everything that they threw at me. I don't understand deductions, credits, refunds. I got a business. I don't know what I'm doing when it comes to tax stuff. What am I supposed to itemize? Am I withholding amount, the right amount? What is the 1040? What is all these schedules that they're asking me to do? But these are some of the things that they want to know. And so what I want to do is, again, unpack a lot of information for you today. Hopefully and prayerfully, I can break it down so that you're able to understand what it is that you're going to need to do when it comes to preparing your taxes. All right, so I got a question that I want to gauge to the audience. And the question is, if you get a refund, it means you paid too much. And I've heard this over and over again from so many different people, even celebrities. I even heard Dave Ramsey put the question out to people. If you get paid a refund, it means too much. So what I want you to do is in the chat, I want you to tell me whether you think this is true or false. If you get a refund, it means you paid too much. Do you think that's true or do you think that's false? So you can type true or false in the chat, or you can type T or F in the chat for me.
Yeah, we have one false so far. Right. All I can see is one false so far, Shamika.
One false?
Yeah.
Okay, I want to hear from a false person, if you don't mind. Why do you think this is false? If you don't mind.
I think a false person may be shy.
Maybe shy.
Oh, they said, to me, a lot of factors come into play.
Okay. A lot of factors come into play. Okay.
One
Anybody
more.
think it's okay? Anybody else? Do we have any more true or false?
Someone said false because of tax breaks.
Okay, false because of tax breaks. Okay, that's a good one.
Another person, the same person who answered false the first time said you cannot pay too much but have a loss on a business.
Okay, you cannot pay too much but have a loss on a business. Okay, it's a good one. So tax breaks, different factors. You cannot pay too much, but have a loss on the business. All right, so we got business questions. Anything else?
They meant overpay.
Overpay, got you, okay. Overpay,
Yeah.
got you. So this question is true, but also false. So the true part of it is the premise of your taxes, of course, is that when you work a job, the purpose of it is to make sure that you are paying your fair share of taxes. And in order to make sure you're paying your fair share of taxes, they estimate how much you're supposed to pay during the year. So if you not familiar with it, all year long, you're estimating. That's all you're doing is estimating how much taxes that you should be paying. Now, you don't know officially whether you pay the correct amount until it's time for you to do your taxes. Then you'll decide, once you do your taxes, then it'll factor in whether or not you overpaid or underpaid. If you overpaid, then you get a refund back. If you're underpaid, of course, that means you'll end up having a tax liability and you'll owe the IRS. So the premise of it is, if you get a refund back, most consider you paid too much. That means you overpaid. That means you gave the IRS more of your money throughout the year than you should have. And I don't know if you're like me, but I don't want to give the IRS no more money than I have to give them. So that's the true part of it. But the false part of it is that, as somebody mentioned, there are other factors that come into play, because some people that get a refund do so because of the amount of income that they make, and it could possibly be in the form of credits. Because if you qualify for credits, then those credits, even though you may not have paid that much into or estimated that much throughout the year, then you qualify for various credits. And then that was the next thing that I wanted to talk about, is that the true or false statement about overpaying works differently for those who qualify for what they call the earned income tax credit. And the reason I pose that question is because most of us that make a certain amount of money kind of don't qualify for certain credits, mainly being the earned income tax credit, because that's going to be one of the biggest credits that people get. When you see a lot of individuals that may be getting back $5,000 or $10,000, maybe even $12,000, you go, well, dang, how did they get back that much? I'm only getting back this amount. That could be because they fall under a threshold. And it used to be the low income credit, but it's called earned income tax credit now, for those individuals who make under a certain amount. And that's kind of, if you think about it, it's kind of like a supplement to those who may not make as much as others make, who maybe fall under a lower threshold when it comes to income. And if you look at this chart that I have here, it kind of tells you, if you don't have any children and you're single and you make less than 16,480, then you would qualify for earned income credit. So if you made anything less than that with no children, then you qualify for a certain amount of earned income credit. And again, it'll be based on how much money you made. That doesn't necessarily mean they're going to give you the max credit, but it'll be based on how much you made. Same thing if you were single and had one child, or dependent that you claim. Same thing if you had two children. You can kind of see how the threshold rises. And so this would be that false part where if you don't pay in a certain amount of money throughout the year, how is it that some of those people get back extra money? This is where that comes into play, because they qualify for what the IRS deems as earned income tax credit for those who make less than certain amounts of money. And it may not seem fair to those of you who say, well, I'm making this, this amount of money or that amount of money. But we just grew up saying life ain't fair sometimes, and we just get over it, because I don't think you want to quit your job just to be able to get earned income tax credit. Moving on to the next part, where exactly do we begin with taxes? A lot of times people will say, why are they not taking taxes out of my paycheck? Why is it that I owe taxes every single year? Why even is my refund so small? Which we kind of tackled that in the previous slide, but why exactly are they not taking taxes out of my paycheck? If you work a W-2 job, just got a new job, or however you're working it, and you notice that every paycheck, no taxes are coming out, what exactly is going on? You might say, well, I filled out the form, but nothing's coming out. When you're doing your taxes every single year, you might pose the question, why is it that I owe every single year? I don't want to have to keep paying the IRS back year after year. To tackle that question, I want to dive into one of what I say is one of the most important things that you need to fill out when you first get a job. These two forms are the main reason why people are either not having to pay back at the end of the year when it's time to do taxes, or are getting back more money, meaning that they overpaid and put in too much because they might have been having way too much withheld instead of claiming that throughout the year. So these tax forms, your W-4 forms, are the vital part of the tax system. Before you get to doing your taxes, you want to make sure that this part of it, that you focus on making sure that you fill that out correctly. One of the myths that people have is that the Human Resources Department is responsible for these forms. They're responsible for them, but ultimately it's your form. You can fill this form out as many times as you need to throughout the year because it's you're able to. That's what you're allowed to do. They can't tell you that you're not allowed to change. You can change your tax withholding certificate whenever you feel like changing it throughout the year. These forms are free. You can download them from the IRS website. I know a lot of employers have them electronically. And so you may be able to go online with your employer and update your form as much as you want there as well. But this is the crucial step to making sure that you don't have that tax liability when it's time to do your taxes, or you're not overpaying too much. And one of the things I always make sure is that anytime something changes, if you get a new job, the form is new now, if you notice, and we did a tax workshop last year this time because there was the W-4 form change. So if you want to know how to actually fill this form out, we'll give you some information at the end about the Legacy YouTube channel, where you can go back and watch last year's one where we talked about the W-4 and how to fill it out. But anytime something changes, for example, you work in one job, you quit that job and you get another job, or you work a job and you're adding another job, you want to make sure that you're having the right amount of taxes withheld. With the new form now, you don't have to fill out one for each job. You can just fill out one for one job and just have the taxes come out of that one job instead of it coming out of both paychecks. And that's for like people with multiple jobs. Or even if you and your spouse both work, you can actually fill out one form with one spouse's job instead of doing it separately, where you fill one out, one spouse fills one out, and another spouse fills it out. Not a lot of people want to go back and change it because it seems complex, but it may not be as complex as you think it is, because it's a lot easier to track it. If you all know, if you're married and you know exactly how much money both of you all are making throughout the year, and you're able to balance your taxes when you do what, if you're filing jointly, it will work out that way. Now, if you're filing separate, you definitely want to keep your W-4 forms separate. But if you're definitely married and you're filing jointly, this would definitely benefit you to be able to fill out one W-4 form. But this is crucial to making sure, again, that you're making sure you're having enough taxes withheld. The most important part is to read through line by line. Some things you don't have to fill out, and then some things you do have to fill out when you're filling out that W-4 form. So make sure that you read step by step. If you don't understand it, there's an instruction sheet that comes with it. The IRS is really detailed about giving you instructions with filling. Even if your employer has it online, you can still get the instructions on how to fill out your W-4 form. The same thing with your state. If you live in a state that requires you to pay state taxes, South Carolina is definitely one of them. You got to fill out a W-4 form for the state as well. So not only are you having federal taxes withheld from your paychecks, you also have state taxes that are being withheld as well. And so you want to make sure that you're doing, you're filling these things out correctly. Again, you can update these as much as you need to throughout the year. If you're not having any taxes withheld from your checks, you definitely want to go back at any point. I would not kind of let it linger too long. You say, well, I like the way my paycheck looking, but you may not like the way your tax bill is about to be when tax time comes. So definitely is February is the beginning of the year. It's the perfect time to go back. Even if you think you may have filled it out correctly, always just go back and check it. Maybe you might have had another child. Maybe you're taking care of a new dependent now, where you might get to claim that child throughout the year. There's so many different layers to family changes. You may have gone through a divorce and now you're single with a child. So there's some different things that you need to make sure that anytime you have a family change or something change with your employment, you always want to update your W-4 form. And then of course, if you find out that you're not paying enough, then you definitely want to go back and update that. To kind of tag on to the fact that there are a lot of states that do have state taxes. Of course, South Carolina is one of them. These are the 8 states that don't have personal income tax. And I kind of threw that in there because you always wonder, a lot of people always wonder why a lot of people from up north come down south to retire. And this is why, because when you come down to a state that has no personal tax, the only taxes you technically have to pay are your federal taxes when you retire. So that's why a lot of people retire to Florida or Tennessee or Texas. Not sure about all those other states. I don't know most people that retire to Alaska or Wyoming. But that's mainly the reason why people kind of retire to other different states. Or it could be, again, even though they may be coming to a state like South Carolina or Georgia to retire, it could be that the taxes are lower down here versus where they're from when it comes to paying state tax. So those are just some states that don't, where you don't have to pay state taxes. So in that case, if you're working a W-2 job, then the only taxes you would be paying is your federal taxes. And so the W-2, of course, was what I wanted to talk about, the first part of making sure that you get yourself set up straight. The other is for people who don't have a W-2 job, or meaning that you may work from home, or you're considered an independent contractor, or you have a small business. That is where you want to make sure that you're keeping up with any extra income that you might be getting. And a lot of people that are independent contractors or do what they call side hustles or side jobs, oftentimes don't understand the tax implications of making that extra money. You may be doing a extra paint job, or somebody asks you to fix some things because you have a construction business that you do on the side, or you do some photography on the side, or you may do have a cleaning business on the side. Oftentimes you may not understand the tax implications of that. If you're making those extra money, there are ways for you to be able to estimate your taxes every time someone pays you. And I always tell my clients that anytime someone pays you, go ahead then and pay those taxes, because what's going to happen is that, especially if you're working for or doing business with a large company and they send you one of these 1099s, because they're going to report the money that they paid you, which means that you should be reporting this income on your taxes. And there's 2 forms that they're going to send you. It's either going to be a 1099 NEC, which is the non-employee compensation form, because you're not one of their employees, you're considered a contractor, which is pretty much the same thing as a small business person, or you got your own business. You may not have a EIN number or physical business, but you still consider a non-employee because you don't work for them. You're going to pay your own taxes on any money that they pay you. That's what we consider an independent contractor, and they're going to send you that 1099 NEC. The other one is miscellaneous income, and this could be for people who have rental properties, where you collect rents. If you collect it through a property manager, they're going to send you that form that says how much money your landlords, the property manager, collected from your tenants. If you want any type of prizes or hit the lottery or won any type of large awards, those things will be reported on the 1099. And a lot of people say, well, what I'm supposed to do with this money? Like, let's just say I won $5,000. How am I supposed to pay taxes on that? Oftentimes if you play the lottery, they'll ask you then about the tax implications. But if there's any other type of awards, or if you worked for yourself or did some contracting jobs for which you received the 1099, then I wanted to kind of show you how you're going to pay taxes on that money, because what you don't want to do is work a whole bunch of contracting jobs, and you might have made $500 on this one, then on the next job you made $1,000, and on the next job you made $500, and then by the end of the year you've made $10,000 for an extra $10,000 for that year for your contracting job for which you did not pay any taxes. And so now you get hit with a tax bill because you didn't pay any taxes on that money as you got paid. And so what I wanted to show you is there's several ways that contractors and people that are self-employed, individuals that are self-employed can pay taxes. The first option is that you can go onto the IRS website, and it's fairly simple. Again, a lot of people think, oh, this just seems so complicated. It really is not. Again, remember I told you at the beginning, everybody is paying what they call estimated tax. And so if you work a W-2 job, you're paying your estimated taxes because you don't know your actual tax bill until you do your taxes. So W-2 people are paying estimated taxes. Independent contractors are also paying what they call estimated taxes. And so when you go in to report your payments, I put this little box to the side just so you can make sure you click on the right one. Just make sure you remember that whatever you click on, if you're making a payment towards your income for any type of side job that you have, just make sure you're clicking on the one that says estimated tax, because that's what you're paying into. And so if you go to the IRS website link, this is what it looks like. Let's zoom in a little bit so you can see it a little bit closer. So this is what it looks like for you to be able to pay into your own tax account. As long as you have a Social Security number, you have a tax account with the IRS, you can pay directly under your Social Security number. If you already have an EIN number for that particular contracting business or small business, you can pay it under your business EIN. If it's just something that you do on the side, maybe you just bake cakes and you really didn't register it as the EIN, that is a-okay, because you can still just claim that business under your Social Security number, and you can still pay taxes on that business through this website. So if you were baking cakes on the side and you made, got a couple 1099s and you wanted to pay taxes on that as you made, well, sorry, 1099s would be at the end of the year. But if they were writing you a check for some events that you might have been planning or catering for, when you receive the check from them and you deposit that check, you can then go onto the IRS website and pay. And it'll just go straight to that Pay Now link, pay online, and you can hit Pay Now with direct pay. You can also pay by card, and this again is for individuals and businesses. There's other ways you can pay here. I'm not going to go into the EFTPS business, but online here, it says Pay Now Direct, and then just hit Make Your Payment, and it's just going to walk you through paying into your tax account. And what happens at the end of the year is they're going to send you a copy of everything that you paid into your own tax account on your own. And then you can then take that and file it on your taxes so that you're not having to pay back. The other option is option 2 to be able to pay into your tax account is they now have different locations for you to be able to pay your taxes. It used to be where you can go into your bank and say, hey, I want to pay some taxes, and your bank will take those payments. Business people can do that. People that have their own EIN number and their small business, those businesses can still do that. Individuals will have to either go online, or your other option would be like they have the Dollar General that can take those payments, Family Dollar, CVS, Walgreens, and then a few other gas stations. I will say you are limited to only $500 per payment. You can make as many payments as you want in a day, because there's no daily limit, but you're limited to how much you can deposit at one time. I don't necessarily recommend option 2, just because you can't just walk into Dollar General and say, hey, I want to pay my tax account, because they may not know what to do with you just handing them cash, and you shouldn't be handing them cash. You have to actually go onto the IRS website and sign up to be able to pay and get a barcode ticket, and then take that ticket to the Dollar General or Family Dollar and then hand them cash. So there's several extra steps to be able to do number option 2. So I don't necessarily recommend that one. I think it's easier to either go online to make those payments, or the other alternative, of course, will always be to just mail in your tax payments as well. If you still write checks, you can just mail in the payment. Now, when you are making those payments, and let's just say you are getting those, your side hustle is making money, somebody just wrote you a check for one of your side gigs, how much money are you supposed to pay in taxes? Well, there's a table that's going to help you figure that out. And you are more than welcome to screenshot any of these screens. All this information that I get is public knowledge. The IRS has a wealth of information, not that you want to dig through their website to find all of it. But these tax tables and things I pull right from the IRS website. So you're more than welcome to screenshot any of the slides that you want to keep handy. But this is just the 2023 tax rate schedule. And it just kind of estimates, let's just say you did do a catering gig and they paid you $5,000. You can kind of go here and say, okay, are you single? The top left corner is for those who are single. If you're head of household, or if you file head of household, then this would be what you would pay. So if I've got a gig where I made $5,000 and I'm head of my household, then between 0 and 15,000, I would pay 10% tax on that money. So if I made $10,000 on this gig, then my tax payment would be $1,000. And again, this is the estimated tax payment that I would make when I go onto the IRS website and pay into my individual tax account. I can just make that $1,000 payment directly on that website. So when I claim that $10,000 on my taxes, I then have that $1,000 tax that I paid in to match it, so that I then don't have to end up having a liability with the tax, with the IRS. Hopefully that makes sense. Any questions so far? I'll kind of stop right there and answer any questions that anybody might have.
No questions so far, Shanika.
Shanika, I do have one question.
Okay.
Trying to follow on the tax rate schedule.
Yes.
When you mentioned about if you made $5,000, or the example that you made, which schedule did you actually use? Because when I look at it, the 0 to 11,000, or the first line of each chart, it says your tax is 0. So how does that make sense? You know, if you're, let's say for instance, for Schedule Z, for the 0 to $15,700, your tax amount is $0.
So basically what they do in the first line, I'm gonna go to you were looking at the one that says single?
Yes.
Okay, so for the one that says single, let's just say, okay, so it's the minimum is 0, but not over 11,000. Your tax implications for that one is just a base 10%. And there's no amount over. If you go to the next line where it says 11,000 to 44,000, your tax is 1,100, but that'll be plus 12% of what's over that 11,000. So that's
Okay,
a base
okay,
number, plus you're gonna pay 12% of however much is over that number to the right.
okay, understood.
Gotcha.
Thank you.
Mhm. Any other questions?
No other questions.
All right. So again, this breakdown here, and again, you're welcome to take a screenshot of this. This is the 2023 tax rate schedule. The last year's schedule, you should be able to find that on the internet if you just Google 2022 tax rate schedule, just to kind of look back to see whether or not you paid enough taxes on any contracting work or extra money that you made on the side. But moving forward, definitely for this year, for those of you who have side businesses or consider independent contractors or even have a small business, I would definitely recommend that you pay into your tax account throughout the year. Even if you don't follow, I do recommend you kind of follow this as much as you can. But let's just say, even if you only do 5%, you're still not having such a huge tax bill at the end of the year, versus not paying anything on any of that money that you get throughout the year. So I definitely would recommend to start paying into it. It gets easier as you do. It's easier if you do it for every job that you do. So let's just say you're averaging maybe 2 catering gigs a month. You can do it monthly on those 2 gigs, wait till the end of the month to go ahead and pay into your taxes and just add up how much you made for those 2 events, and then go ahead and pay it monthly. Or if you choose to just do it every time somebody pays you for a job. Now, if you're doing a lot of jobs, that might be more work, but if you're only doing a few jobs per month, it may be easier to just do it monthly. I definitely wouldn't wait to do it quarterly. That's just because then you have to go back and sit down and do a big lump sum. And then it kind of looks like, oh man, I'm giving them too much money because you waited to lump everything together for like 3 months at a time. A lot of businesses do pay taxes quarterly, a lot of your bigger businesses, but that's just because they have accounting departments or accountants that keeps up with their books for them. But for small business people, it kind of gets away from you from waiting too long to do it. So I would definitely, I do mine's monthly, and I definitely recommend monthly whenever you do your monthly bills. Also do your tax bills for your business as well. Any questions before I move on to the next part?
No questions in the chat.
All right. So the next part of the ABCs of taxes is going to be the fundamentals of actually filing those taxes. What tax credits can I get? These are some questions that I get from others. What can I deduct? What can I write off? I don't want to have to pay all this money back. And I'm going to answer the questions to that, but I always go back to the beginning. If you work a wage job, you want to maximize your credits and deductions on your job throughout the year, so that you don't have to wait on tax time for them to give you back part of your money, because that's essentially what they're doing. Remember, we said that the money that you're paying in throughout the year is estimated tax. And if you're not estimating enough, you're going to end up giving the IRS more of your money versus you keeping more of your money through the year. So for those of us like myself, who I don't look for a huge refund or refund at all throughout at tax time, because I would rather get as much of my credits and my deductions throughout the year for my W-2 job, so that I'm not giving the IRS my money to sit in a bank account to collect interest and to do other stuff with. So that's the point of the whole tax system. But when it is time to do taxes, let's talk about what can you qualify for to also reduce it at tax time. So the credits is what I want to talk about first, because everybody hear about tax credit. Well, I want to get some credits. How do I qualify for credits? These are some of the most popular tax credits that most people qualify for. I talked about the earned income tax credit in the beginning. Again, remember there's income limitations for people that qualify for earned income tax credit, is more along the lines of individuals who make less than a certain amount. Again, in the beginning, it was deemed low income credit. They changed the name to earned income tax credit. And so that's for individuals to be able to get more money back in their taxes in a form of earned income credit. So most of us that don't meet that threshold won't qualify for it. Another tax credit that's real popular is the child tax credit. That's for those of you who may have children under the age of 17. Once that child turns 17, they don't qualify for the child tax credit. It doesn't mean you can't claim them. You'll still get credit, but it won't be up to $2,000 because they're reached that age of 17. But if you have children under the age of 17, you automatically qualify for that child tax credit. It does phase out for those individuals who make couple $100,000 or more. A lot of these taxes phase out for individuals who make $200,000, $300,000, $400,000 or more per year. The IRS don't really give you those types of tax credits, but there are other tax credits, of course, for individuals that end up in a higher end for taxes. You also have the child dependent care credit. That's for a child that may be in daycare or after school care. It caps out at children at the age of 12. So basically, if the child is under 12, you can write off the child care credit, or if they're in after school, you get up to about $3,000. Same thing with dependent care. If you're taking care of an older relative or your elderly family member, your mom, your dad, anybody that's older, or if you're taking care of a disabled child or a disabled adult, and you had to pay for their care so that you can go to work, then you can also qualify for dependent care credit. I will say though, if you're trying to get the dependent care credit and the person is coming into your home, you may not qualify for it. They really, because they're considered that a nanny. So if you're going to write that off, they normally will make you write it off as if that person is your employee, which means you would have to pay employment taxes. So that part of it is a little bit tricky. But if you have to take them to a place, like if you take them to a nursing home or a elderly care center or a care center for them throughout the day while you work, then that's definitely a direct dependent care credit that you would qualify for. So if you got any further questions about that, I can kind of answer those. Another credit that you qualify for if you got traditional IRAs, not a Roth IRA. Roth IRAs are not, you don't get credit for those on your taxes. They're good to have, but you can't write them off on your taxes. You don't get a credit for them. Your 401k, those are automatically, if you work a W-2 job and draw, and of course get a 401k, they're going to put that in those boxes on your W-2. That's going to automatically transfer over to your tax returns. You don't have to necessarily go in and do a separate credit for your 401k. But if you have a traditional one that you might have signed up yourself outside of your job, let's just say you signed up with one with Prime America or any of these other banks, then they'll send you a statement to be able to write off your traditional IRAs. Same thing with education credits. If you have a student that's in college, or if you've been in college, if you've been in school yourself, there's two types of credit. There's the American Education Credit, and then there's the Lifetime Learning Credit. The first one that they make you take is that the American credit. because that one is the first 4 years of your education. And then after that, if you had to take some courses at work, or you had to go back to school for your job, they require you to take some online courses or anything that you had to, or any credentials that you had to pay for your job. Those are considered education credits as well. And you get to also write those off. Just make sure that anything that you're paying out of your pocket, that you keep receipts for. If you had to buy a computer that qualifies for education credits, if you use that for school, you had to buy a new printer, education materials, those are all things that you would get credit for. So just make sure that you keep the receipts of those additional items as well. And then a few other ones I threw on there that are kind of popular as well. The residential energy credits. The only thing I would tell people about this one is that just because you fix up your home does not mean that you can write off those things on your taxes. It's not the it's not the home improvement credit like it used to be. It's basically just the residential energy credit. So if you had to put on a new roof, that roof had to be a certain material in order for you to be able to write it off. If you had to replace your hot water heater, it had to be some type of energy efficient or new type of equipment. So when you purchasing different equipment for your home or replacing or improving on your home, again, maybe like the windows, if they're energy efficient type of materials or something that blocks out the sun or the heat, any modern type of upgrades that you do, those are, or you're limited to those when it comes to being able to write off any type of energy credits. There's a list of other ones as well on the IRS website. And again, if you have any questions about any of these types of credits, definitely look them up. But you do get to write 30% of your costs. And then of course, these costs are non-refundable. That just means that they're not going to give you this money in the form of, they're not going to give it to you in the form of money. It's just going to be credits that's going to reduce your tax bill. So it won't be if you spent, let's just say $1,000 on the energy efficient hot water heater, you're not going to be able to get $1,000 back on your taxes as a refund. It just means that if you owe $2,000 to the IRS, they're going to take that 30% of that credit and reduce your tax bill. So that's all what that credit does, is reduces your tax bill. So it's not a refund that you would get. It would just be a reduction in tax liability. And then the other ones would be your motor vehicle credit. If you got electric vehicle, and then if you're a first time home buyer, you get credits for that as well. Any questions about credits?
Yes, we have a question in the chat. What tax credit does private school tuition fall under?
So private school tuition doesn't fall under any tax credit, unless it was child care credit, like you sent them there after school, or it was a daycare for a child that's under 4 years old that goes to daycare. But there's no tax credit for private school.
Okay. And I'm not sure if this is pertaining to this, but do you know the deadline for the rebate for 2021? The person thinks it's this month, but doesn't know the exact date.
That one I would have to look it up. Is that for the South Carolina rebate?
Let's see. Yes.
Gotcha. Yeah, the South Carolina one. I remember just reading something about a new update, because before it was just if you did your taxes, if you completed your taxes on time in 2022, then you qualify for that South Carolina rebate. And then they went back. I guess they were trying to make sure everybody continues to do their taxes. But I'll look that up and I can email that out. But if you drop your email in the chat, I can.
All right. And just one more question here, because this is a really good question. What software would you suggest to keep up with your income and expenses for your business. One that can like run reports.
Okay, so there's a lot of different ones out there. And it just kind of depends on how dedicated you are to being able to do put your stuff into the system. I personally use QuickBooks. QuickBooks is a real popular one that a lot of people use. They do have simple versions of QuickBooks. They do have online versions because I use the online version myself, but they do have a simple version that you can use for QuickBooks where you can actually connect it to your business bank account. And then every transaction will be flown into your accounting software. Now you do with QuickBooks, you do have to go in and categorize those amounts in there because it doesn't do that for you. You will still have to go in and put everything where it needs to go. But it does help with not having to go and look at your bank statement every time you make a transaction. You can just do that at the end of the month. There are some other ones out there. I know Mint has one as well. Mint does a budget one for personal, and if you like contracting jobs, Mint probably works good as well. I believe TurboTax might have one as well, but I definitely recommend QuickBooks just because they do, and then it connects with your payments, whatever type of payments that you take for your business. QuickBooks does take a lot of those different payments as well. But definitely do your research on the different accounting softwares because some of them there may be some out there that are a lot simpler than QuickBooks, but that's my go-to. Most of all my clients are using QuickBooks as well. The ones that are not using QuickBooks are just kind of old school Excel, and I'm still Excel myself. I still use a lot of Excel spreadsheets as well. So if nothing else, definitely do an Excel spreadsheet. If you don't have a lot of expenses, you may not need to purchase a software. It may just be you take a spreadsheet, you make sure you log in all of your income and just keep all of your receipts and go back in and just add your receipts up and put in different categories. So that will probably work as well, especially if you're just starting out.
And Shamika, does any of these softwares, when you do add your income and it gives you a running total of your income, does it also calculate what taxes you would need to pay?
So that part is definitely not in any tax program. I mean, in any accounting software program. You will have to know that yourself based on how you file your business or how you create your business. Anytime you just start a business by yourself, you're automatically assumed to be a sole proprietor, and everything that you do with your business goes on your individual tax return. So that's the easy part of running a business by yourself. My business, even though it's a LLC and it's separate and I have a separate EIN number, that still goes on my personal tax return. It's going to go on what they call a Schedule C in that tax return, but it still goes on my individual taxes. So there's no separate tax return that I have to do for my taxes. I just do my business part inside of my individual tax return because they have a business portion in your tax return, if that makes sense. The only people that would be doing separate tax returns would be a company that's a small corporation, and you would know if you're a small corporation because you have to file papers with the IRS to become a small corporation, or if you're a partnership. And then of course the larger corporations. But if you didn't file paperwork to be a partnership, or if you are a partnership, even if you didn't file papers to be a partnership, if there's more than one person, you have to do a separate tax return. And then of course, if you're by yourself and you elect to be a small corporation, then you file. But everybody else, if you didn't file, you would know whether or not you have to file a separate one, because you have to file to be able to separate your business. You can still separate your business. Like I said, my business is a LLC and it's separate from my personal. But I still file that. Tax is different because you still file it under your personal taxes.
All right, we got one more question.
Okay.
Yep, it's like two more just popped in. So the first one is, how do you know what business or personal tax bracket you're in?
So there's a tax chart. If you, and I didn't put the tax chart up here, but if you go to Google and you just Google income tax bracket, you can pull up the tax brackets because it'll be anywhere from 15% tax bracket, 22%, then it goes to 24, 28, and I can't remember those other numbers. But yeah, you can pretty much Google that tax bracket, and that'll be based on about the amount that you make per year. So if you made less than 80,000 a year, or from 40 to 80, your tax bracket may be 20 or 15%. If you made between this amount and that amount, then your tax bracket may be 24%. And then what that number means is that that's how much taxes they estimate. Because remember, again, we're estimating taxes. So that's the estimate of the amount that they estimate you pay on all of that money throughout the year. So if your tax bracket is 22% and you make 50,000 a year, then you should be technically paying taxes on 22% of that income of that 50,000. Now, you may not necessarily pay all 22% because remember, if you're filling out that W-4 form correctly, you can get part of your credits and deductions throughout the year, where you may not have to pay that 22%. It may be half of that because you have credits and deductions. So that's why you want to fill that W-4 form out correctly throughout the year, so that it reduces your tax liability.
All right, got another question that popped in.
Okay.
If you got the rebate for having a small business that you filed under the Schedule C, would we still need to file on this year's taxes?
If you read that one to me one more time.
If you got the rebate for having a small business that you file under the Schedule C, would you still need to file on this year's taxes?
Yes, whatever tax year, if you got that rebate in 2022, then yes, that rebate will follow you with your 2022 taxes. It doesn't mean that you will have to pay taxes on it, but you would have to file the fact that you received that rebate, yes. If it was for 2021 and you haven't done that 2021 taxes, then you would go back and put it with your 2021.
All right, that's all the questions in the chat.
All right, and then the last one thing that I wanted to go over was the deductions. So we talked about the credits. The other thing to make sure that you want to write off is your deductions, and these are just some of the most popular. Again, there are tons and tons of more credits and tons of more deductions. I stick with the ones that are most popular one. Those are the ones that I kind of explain to people a lot. These are not the end all be all of tax deductions though, because there are definitely more tax deductions out there. These are just the ones that are the most popular that people qualify for, based on my 20 years in the tax business. The first one is going to be your itemized deductions. And that's going to go, again, these are going on your individual tax return under the form Schedule A. And what happens is the IRS gives you a standard deduction. And what they tell you is that they're going to automatically give you that standard deduction. If you decide to itemize, that means you have medical expenses, dental expenses, you got some property where you pay taxes on, you might have a mortgage where you pay interest on, you may have charitable contributions that you give every single year. If those amounts total more than what they give you for standard deduction, then you qualify to itemize those deductions. So that's what it means when you say itemized deductions versus standard. And if you look over here at the chart, The standard deduction for single or married filing separate people is $12,950. So if your itemized deductions are not more than that $12,950, then they're just going to give you the standard deduction. So oftentimes when you're writing off stuff and people say, well, how come I can't just write off my charitable contributions? If the charitable contributions are not more than the standard deductions, then they're not going to give you, and then it doesn't make sense because they give you that standard deduction. So you would definitely need to have the medical, the taxes. A lot of people, especially those who buy a new home, the mortgage interest end up being a lot because you got your points and your interest, and then you got your property taxes. You even got your state and local taxes, which is your vehicle ad valorem taxes that you also get to write off. And then you may have your church contributions and any other nonprofit organizations that you donate to, all of that, or Goodwill. All of that, again, would need to be more than the standard deduction. Otherwise, those amounts are not going to qualify. And it doesn't matter if you put it in the system. Even if you're doing your taxes yourself and you put this stuff in the system, they're gonna take the one that's the most. So if it's not over the standard, it'll be in the tax return, but it's still not gonna, they're still gonna give you that standard deduction. Some other ones real quickly, the student loan interest. If you're paying on student loans, your interest on that is tax deductible. You should get a form. If you don't get a form, definitely log into your student loan account. If you're a teacher or educator, college teacher, or any kind of private school teacher, public school teacher, if you're an educator, guidance counselor, you get to write off up to $300 of your expenses. If you have a health savings account, you get to write off the amount that you spend on your health savings account. I will tell you, if you have a HSA and you don't spend everything that's in there, you are going to have to pay taxes on it. That's the purpose of having an HSA. So if you get one, make sure you get one, because you or your children often go to the doctor quite often throughout the year. If you don't visit the doctor a lot, it does not make sense to have a health savings account, because you're going to end up with having to pay money back on whatever's still sitting in that account. And your wherever that HSA is, they're going to send you a document at the end of the year with whatever is left in there, because you're going to have to write that off on your taxes and pay taxes on it. Reason being is because that money came out pre-tax. So anything you're putting in your HSA is coming out before your taxes are taken out. So if you don't spend it all, that's the benefits of it, is that it's tax-free if you spend it all. If you don't spend it all, you're going to have to pay taxes on what's left in it. Your moving expenses, it used to be if you move for your job, that's eliminated. The armed forces are the only ones that qualify for moving expenses. If you have to pay alimony, that's a tax deduction. If you have a home office, your home office is tax deductible. You are limited to the square footage of that office. So what you would need to do is figure out the square footage of that office space ratio to the ratio of your entire house. So I would take the square footage of your, what they're going to do is divide the square footage of the office space to the entire house, and that'll be your percentage. So if the house is 1,000 square feet and your office space is 10 square feet, then of course 10% will be your home office deduction. So you would get 10% credit for your utility bills for the year, 10% of your internet, whatever home office expenses that you use at your home, you would get to write off some of those utilities based on that percentage. And then of course, if you pay self-employed health insurance, you pay your own insurance out of your pocket, not through your job or anybody else, then that would be a tax deduction as well. I know I'm kind of running through this fast because we're at the end of our time. And then the last thing is for those of you who do have a small business, I talked about the Schedule C. This is basically all the expenses, and you can definitely welcome to screenshot this screen. But These are just some expenses that you get to write off for your business. And again, if you have a side business, even if it's a side hustle, that's gonna go on the Schedule C. If you're an independent contractor, that's gonna go on the Schedule C. So they're gonna send you a 1099 and you're gonna file that on the Schedule C. The Schedule C is a part of your individual tax return. So anybody that has a side business by themselves is filling out a Schedule C. Anybody that has a home-based business is filling out a Schedule C as well. So if you're doing your taxes yourself, just make sure you know which form you should be going into. It they may not tell you the form. If you're doing TurboTax, it may ask you if you have a home-based business or if you have a business. And then it'll take you into the form, which it would be a Schedule C, where you put your information in. And last but not least, do I pay taxes if I receive Social Security? This is where we get into the end. You worked all these years, you're getting ready to retire. You want to know at what point do I stop paying taxes? If I get Social Security, do I have to pay taxes? Do I still pay taxes if I'm retired? The answer to all of these is yes, you still have to pay taxes. The only time you stop paying taxes is if you've ever remember that slogan where it says there's two things that's certain in life, death and taxes. They are one and the same. When you leave this earth is essentially, for the most part, when you stop paying taxes, especially for those who retire from a job. If you've worked the job for 20 years, 30 years, and you're drawing retirement and they're taking taxes out of that retirement check, then for as long as you're still on this earth, you're still filing taxes and paying taxes on your retirement. If your income drops below a certain threshold, then that's when you can stop filing a tax return. And this will be the chart for those who wouldn't have to file taxes. So for example, if your filing status is single, at the end of the year, if you were under 65 and you made less than 12,950, then you don't have to file a tax return. If you are 65 or older and make less than 14,700 for the year, then you don't have to file taxes unless you expect to get a refund back. If you expect to get some of your money back, you can file just to get your money back. Same thing with head of household. If you're over that threshold, 65, and make less than that, 19,400, then you qualify where you don't have to file a tax return. And then the difference between single and head of household, single can be anybody that's filing taxes by themselves, whether you have children or not. Head of household, you can only file taxes for head of household if you have dependents. If you don't have any dependents, you cannot file head of household. That's the status that's only set up for those who are responsible for any type of dependents and qualify for taking care of a home. Any questions? I'll take some questions after this. I'll leave you with this. This is one of the songs that I heard throughout the pandemic. If you haven't heard it, Jonathan McReynolds and Mally Music, called Adulting. I know all of us wish we could grow up when we were younger. We was ready to move out, and then came bills and taxes. This song pretty much sums it up perfectly. My daughter, actually, my oldest daughter, was the one that put me onto this song. And I said, that was a song that definitely, like, if there was ever a song that perfectly describes you, it was this song, because adulting is definitely not easy, especially trying to pay taxes, learning about taxes. Why do I have to do this? Why do I have to pay that? That's just part of being an adult. It's something we got to do, unfortunately, and we're going to be doing it until we leave this earth. With that being said, if you have any questions, definitely drop them in the chat. I'll go ahead and take some questions.
We don't have any questions in the chat.
All right, any small business questions? May not have any individual tax questions, but anybody with a small business that may have a business question, you're definitely welcome to unmute yourself.
Question, would it be, if you do have a small business, would it be best to set yourself up to create a LLC?
So one of the things I want to make sure people understand is that a LLC status has nothing to do with your tax implication, your tax liability. The LLC just simply means that your business is separate from your personal, and it's basically a liability issue. I have a LLC as well, but I did so just to make sure that my personal debts are separated from my business debts. That's all a LLC is for. I hear people tell others all the time, oh, you need to become an LLC, you need to do an LLC. That has nothing to do with how much taxes you're gonna pay or what tax forms you file. The only thing LLC has to do with is the liability. That's why it stands for limited liability company. It just has everything to do with your business being separate from your personal. Depending on what you do, it is a good recommendation, depending on what your business is, to separate, to file as an LLC, to separate your business from your personal debt, so that, let's just say, hopefully, hypothetically speaking, nobody ever sues you. But if, for example, you do get sued, they can't come after your personal assets. They can only come after the business assets. So only the business will be responsible for business debts of any kind.
Good stuff. Also, you mentioned the HSA account, but what are the top tax implications for having an FSA account?
The HSAs and FSAs kind of work the same. Again, you just want to make sure that if you're going to get these tax accounts, that you are spending them only for what the purpose of them is for. Because if you do get audited, they're going to ask to see, for example, your receipts for your FSA or your HSA account. So if it was HSA and you went to the doctor, they're going to see the receipts for the co-pays that you made or how much you paid to the doctors or the dentist office. So you definitely want to keep those receipts for those accounts if you get audited.
All right. Saw all the questions in the chat.
Well, thank you all for having me. I do have 2 giveaways that I wanted to give out. But before we do the giveaway, if anybody registered after 9 o'clock last night, or if you just jumped on the Zoom link and want to get in on the drawing, if you would just drop your email in the chat. If you pre-registered before 9 o'clock last night, we already have your name entered into the drawing. Just for those who might not have registered and just came on, if you would just drop your email in the chat. No new, okay. So I have 2 gift certificates. One gift certificate is for 50% off individual tax preparation with my company. And then another gift certificate is for free business consultations. If you have a small business, I'm giving away a free business consultation. If you do your own stuff and it doesn't qualify and you want to give it to somebody else, you are more than welcome to bless somebody else with the gift. So I'll go ahead and draw the names then. Anybody drop anything in the chat? Okay. All right, so I'm gonna go to the wheel. And we're gonna shuffle. So the first one is a gift certificate for 50% off individual tax preparation. And we'll do for the ones that showed up. So that's gonna be, is LaKanya on?
I do not
Not
see.
see her. Okay, so we'll draw that one again. All right, so we got Sam Leo Smith at yahoo.com. Is that person on?
I think Sammy Smith. I believe he was on.
Yeah, I believe I saw that.
Yeah,
So,
I think
all
I
right,
did.
so Sammy will get the 50% off
Mhm.
tax preparation. And then the last one is for free business consultation. All right, that one's Apostle Sam. I don't think he was on with me.
No, I don't think.
Okay, so we'll do that one again.
Uh-huh.
All right, so that's that email. Is that person on?
Don't believe so.
Nope, okay. Is that person on?
That is Minister CJ. I did not see.
One, MAD1.
I did not see him on.
Okay, let's try this again. All right, so this one again is for a free business consultation. All right, is that person on?
Yes, she is on.
Awesome. All right. So I will email you these gift certificates. So that one is for a free business consultation. Again, if you can't use it, you're more than welcome to pass it along to somebody else that you, or bless someone else with it.
Yes, she jumped
Yeah.
off at the end, but she was
Got you.
there during the class.
Got you. Okay. Well, thank you all for having me. It was a pleasure speaking with you all today. That's my contact information. I'm located right here in Moncks Corner, South Carolina. I definitely can serve all 50 states. I specialize in individual small business tax preparation. I can help you start your business up. I can help you set up your bookkeeping, even if you don't want the bookkeeping services. I can definitely help you get your stuff set up. I know some people had questions about getting their business set up with different accounting software. That's definitely something I do as well. The barcode is a link to my website as well. If you take a picture of the barcode, it'll link you directly to the website. Definitely follow me on Facebook. I'm going to be doing next month, I'll be doing a small business session just like this for all of my small business people. So if you follow me on Facebook, you'll be able to register for that session. It'll be March the 17th, I believe, but definitely follow me on Facebook and you'll be able to see the advertisement for the small business tax workshop that I'll be doing on next month.
All right. Thank you so very much, Shamika. You definitely cleared up a lot of things, especially for me. You answered a lot of my questions. But if anyone has any more questions, please reach out to Shamika with her contact info. You can also email the Legacy Program, and that email address is on the screen, legacyprogram227@gmail.com. Also, please follow us on Facebook. We post a lot of our classes and helpful information on Facebook. So please follow us, and that is at My Legacy Program. All of our classes from last year and any classes that we do We do upload them to our YouTube page. So subscribe to us on YouTube, and that's at My Legacy Program all together. You also want to make sure that you click that bell icon in the top right-hand corner of that screen so that you can be notified about any videos that we upload to the page. All right, that is all that we have today. Thank you again to our speaker, Shamika Smalley. Thank you all so much for joining us, and we hope you have a wonderful weekend. Bye-bye.
All right, you all have a good day.
Okay.